Hello friends, good morning. Let us continue our studies of capitalization. Today we are going to watch a small video on the factors that are affecting on capital structure. As I said, capital structure is nothing but the skeleton or the format which can give you an idea about the amount and the percentage of particular source of capital that has helped in the process of capital formation. So we need to understand the several factors that are impacting onto the capital structures. So the factors are EBIT EPS analysis, cost of capital, leverage, analysis of debt capacity, cash flow analysis, control, flexibility, timings of the issue, growth rate, stability of earnings, attitude of the lenders, and taxation structure in the economy. I will explain them one by one. Factor number one, EBIT EPS analysis. When you do a capitalization or when you are forming the capital structure for your business, you have to give a due consideration to EBIT EPS analysis. This particular analysis will help you out the impact of earning per share, the impact on earning per share due to the several approaches of raising the capital. So when you raise different methods to have the capital availability to your business, it impacts onto the riskiness and also onto the interest payments and then the dividend distributions, and that in turn would impact onto the earning per share possibilities for your business organization. So when you do EBIT EPS analysis, you can better map the impact of several capital structure approaches onto the EPS of a business venture, and then your attempt is to make sure that highest EPS wala attempt is something that I am gonna eye. Second point that goes in the process of capital structure is cost of capital. As I told you, cost of capital is the minimum rate of return which every capital is going to expect, or it is cost of raising the capital. So I have to give a due consideration that whenever I am raising the capital for my business, I must go on for the lowering down of cost of capital. So the particular option through which my cost of capital is low, I have to go and chase that particular map or road for raising the capital for my business. Another factor is leverage. Leverage is a measure of risk for the business ventures. Basically, there are three types of leverages: operating leverage, financial leverage, and combined leverage. All these factors impacts onto the capital structure and adds risk of different types to the business ventures. Hence, when you are raising the capital, you have to give a due care to the leverage and its impact. Another factor that impacts on capital structure is analysis of debt capacity. I call it as a debt serving capacity. As you all know, there are two major sources: equity sources and debt sources. Debt sources are the ones which are external in nature and hence demands interest from the business venture. So when you are raising debt, it demands interest, and when interest is to be paid, it is a compulsory obligation that arises onto the business venture. So when you are making on the capital formation, you have to observe and understand the debt serving capacity or the loan repayment ability of your business venture when you are making on the capital formation. Another factor that impacts onto capital structure formation is cash flow analysis. There are businesses wherein money keeps coming to you on a regular. There are certain business ventures wherein money do not comes on a continuous basis, whereas sometimes it goes too high, sometimes it goes down, sometimes it goes high. So there is irregularity in getting on the money to your business venture. So if cash flow is uneven, you have to plan the capital structure differently, and if cash flow is uneven, you have to plan capital structure differently. Another factor is control. When you are raising the capital, as I told you, one of the source of capital is equity sources. But as you know, when equity source is extended, you are also supposed to extend your business ownership to other shareholders. Hence, if you will rely on to major equity sources for your capital raising, your ownership gets diluted, and hence you have to give a due care to control while raising the capital structure for your business. Another factor is flexibility. When you raise a capital, it is not the only time when you will be needing money. There may be situations of expansion, diversification, extension of your business to new places and new technologies. So all such situations would demand additional amount of capitals for your business venture. And hence, you should always keep an element of flexibility within your spaces to make sure that for the future course of requirements, you will have the sufficiency of abilities to raise those additional requirements of capital. And hence, flexibility should also be given a due consideration in the process of capital formation. Another factor is timing of the issue. Timing is of course very important when you are raising the capital. If market is good, if there is a good demand happening in the share market, when people are having good money available to them, when purchasing power of the customer is good, when bank is providing you the lower rates of interest, this is the best time when you can raise the capital. So timing of the issue is also something that needs to be taken care when you are raising the capital sources. Another factor is the growth rate. If economy's growth rate is growing, there are people who will have money and interest and capacity and purchasing power to invest, and hence growth rate of an economy should also be taken into consideration when you are raising the capital. Another factor is stability of earnings. There are businesses which has a long tenure in its purview while deciding upon the course of business. So the businesses which has long purview in nature, you can have another sources of capital structure to be in action. And if business tenure is a kind of risky one, wherein the amount of tenure or the sustenance or stability is something which is a dilemma, in those situations your capital structure has to become differently. Another factor that goes for capital structure formation is attitude of the lenders. Sometimes because of the stiffiness or competitiveness of the market, you have a very scarcity of lenders availability of funds. So funds are available at a expensive rates. In such situations, raising the capital through lenders becomes difficult, and hence attitude of lenders is also something that you have to eye upon when you are doing the process of capital structure formation. The last factor that impacts on capital structure formation is taxation structure. Friends, as you all know, debt is a tax deductible item. So if there are high tax deductible possibilities are there onto the debt sources, you better rely onto the debt sources, because that gives you additional cushion or subsidy in the repayment of your liabilities. So yes, tax structure is also impacting onto the capital structure formation. Friends, these are the several factors that you need to eye upon for the capital structure formation. Now, I will just show you one small format of how EPS can be calculated when EBIT is given. So first of all, EBIT is earnings before interest and tax. Another name for the same is profit before interest and tax. So when you get a PBIT or operating profit of your business, the first thing that you will have to deduct is the interest. Interest is nothing but the repayment of the charges to the debt servers who have provided you either bond or debenture or loan for forming the capital. Once you deduct the interest, you get a concept called earnings before tax or profit before tax. Then the claim is of government. The economy into which you are living, you are supposed to make the payment of taxes to them for the societal requirements of provision of several services to you in the form of roads, rails, transportation, healthcare, education, safety, security, then provision of energy, electricity, etc. Government needs money for that, and hence every individual who is into the economy, either a business venture or an individual, he has to make the payment of interest or taxes to the government. So yeah, you have to pay taxes as well. So EBT, then you pay taxes, and then that remains a profit portion. We call it as a earnings after tax or profit after tax. Out of the profit after taxes, you will have to make the payments of preference dividends if you have raised funds from the preference shareholders. If it gets deducted, you get a term called earnings available to equity shareholders. I call it as a EAESH. And when you divide, this EAESH by number of equity shares, you get a very important financial concept called earning per share. Earning per share is something which every business venture wanted to increase, because this is the right reflex to understand how much percentage of profit every shareholder has earned on the basis of the business that has happened throughout the year. So yeah, this is the process by which you can find out EPS when EBIT is given, and this is one of the important factor in the process of capital formation. I hope you have enjoyed watching my video on the factors impacting onto capital structure. Keep eyeing upon the videos of similar types and continue your studies of financial management. Thanks for watching.